just after 3 p.m. Eastern Time. Welcome back to the final hour. It's May 16th. All the market's done today is just slowly melt up higher. We've seen that a day or two, haven't we? It's just been drifting since Monday's gap. We are creeping up towards the 595 strike right now. We were as low in the SPY as 589.30 this morning. Grabbed a quick little profit on SPX this morning. It has been a melt up ever since. I tried the 595 level, but it was really like outside of where prices could go. I expected like maybe a $2 to $3 move today. And from the bottoms of 589, we're now up 5 and change. So, it's kind of too late to take a trade unless I want to try to pin something here at 595. Maybe we get there, maybe we don't. Let me see something here. If I looked at the SPX, let's see if we get on the SPY. So SPY, end of day. This might be relatively expensive to trade this one, but if I did a call fly, try to pin it here, yeah, there's a little bit of profit, but this is at stage of the day. I mean, the last 52 minutes, you're paying for most of the gain. This trade was about 30 cents this morning to get in around a 590, traded up for a 595. That was a little bit better. That was 30 cents is now showing about 80 cents. So not going to jump into it now, but I'm just curious if there's still some reward to risk that's offered in the trade. If we do end up pinning at 595, hooray. If we end up rejecting at 595, I mean, I can get a higher strike. Let me check on the SPX for today. If we go up any higher, I mean, we could still get, this is kind of nuts. I mean, we could still get a couple of bucks. I mean, 6,000 is not going to pay, but that'd be ridiculous to have like a 40-point squeeze up at the end of the day. So put side, I mean, going back to like 5,900, that's going to pay next to nothing. 59, yeah, those are 10 cents. 59.30 end of day. I just don't have a level that I like. So this is SPX, trying to maybe drift a little bit higher through the last 50 minutes. I mean, that'd be a pretty big push if we end up going up to 6,000. But when I looked at the SPY earlier today, 595 was the strike. And we're getting there. So this has been growing from about I think about a 300 net today to now 519. So a little bit order flows, probably 200 million coming in or something like that in SPY ETFs. We still have this one up here at 600. I mean, if we see 600 next week, I'm just going to continue to show a little bit of annoyance with the market. This is why I did the screenshot or the thumbnail today is embrace the melt up, because maybe this whole pullback that I want isn't going to show up. I think it still will. I'm trying to be patient for it, but I'm also not going to sit around and wait to place trades and generate income. I mean, I look at the market this way. I think it's a pretty clear question now. If this market is able to get back to all-time highs, whether or not we have a pullback, here to all-time highs or deeper to all-time highs, or we just straight up go to all-time highs. I mean, it's in this area where I'd say, man, I really hate participating at these all-time highs, but I can see the market still going up, So I'm just going to continue to kind of adjust my price patterns. But what I did do today is I sold some puts on the SPY. I sold a 475 put today on the SPY. I went out to December 19th or December 31st, I think. Let me double check that. Here. December 31st, 475 put. I collected $6.37 on my accounts. On my IRA accounts, I did a 60 wide and collected over $3. So I'm willing to own the shares. If the SPY came all the way back down to 478, or 475, I'm gonna own the shares. I looked at the Russell, I looked at the Qs, I looked at the Dow. I'm just gonna stick with the SPY for right now. It's one of the most liquid ETFs, and I'm just gonna continue to use boring old covered calls for some of the ownership that I do have. Some I want to let run, some I don't. I did add a couple of trades in on PayPal and SPY. The melt up continues. I mean, I'm up on the day, close to the highs for the year at 225. but we will see what happens. So I would like a pullback, but I also don't know if the market's like, you know what, let's go ahead and just go in. We're 4% away or inside 4% away from the all-time highs. Okay. I mean, there's clearly an absence of selling going on. This is a very thin, lower volume market. Sentiment has shifted though to the other extreme. We went from extreme fear to now greed. We're kind of tipping the scales between that fear and greed and extreme greed. The put call ratio is pretty excessive as well. If you take a look at, I think I have it here. I mean, we're showing some extreme greed in the put call ratios now from what was pretty severe fear. And again, there's still room to run. I talked a lot about this yesterday with some of the bigger technicals. We are stretching into overbought conditions. We could show that via let me use a different workspace here. I'll see if the SPY ends up going to 595 today. If we hit that chart alarm, let's go 595. So that'd be the liquidity level that I'm after today. Maybe it gets there in these final 45 minutes or so. Jonathan says, will inflation cause the market to go down? Won't tariffs? I mean, what inflation? Right? I mean, this is truflation. I mean, it could, but inflation is so 2022 and 2023 and 2024. It's like, why does everybody care about inflation now? And honestly, what's the best way to combat inflation? What's the best way to fight inflation? Owning stuff, right? Owning assets. So what appreciates during inflationary windows? Assets. What's everything in the stock market? Assets. You know, so I think that what would cause inflation to choke out growth would be that earnings get worse. But this quarter, earnings weren't bad. In fact, consensus was pretty solid, pretty upbeat. Once they started to remove the negative guidance because, like, hey, we don't know. We're just not going to talk about the future because we'll wait for this tariff stuff to play out. I mean, earnings were most part consensus wise were pretty good. And buybacks were, I think, as high as they've been since like 1980s. So we had like record amounts of buybacks once the window opened up in April. So yeah, I mean, we've had a lot of buybacks. We've had solid earnings. The market it hasn't been like high volume, but there's certainly participants that have just been, maybe sitting on the sidelines. Perhaps this was when there was some more money coming off the sidelines, like during this indecision or during this like China pump, the U.S. China 90-day pause. So look, I'm as curious as everyone else. Are we at all-time highs? And here's what I've got to ask. Is Trump going to come back in and try to do something like he did here? Why would he do that? I mean, he's clearly like one of the most unpredictable presidents we've ever had. But at the same time, I also think that what can he celebrate right now? Right? He almost broke the global economy right here. What's he celebrating? Nothing. Right? What's he celebrating now? All-time highs. So he can say, look, I told you. Right? I told you it's a good time to buy. I told you it's a good time to buy. So he's not wrong, but it's also weird how it happens. You don't see a president that does that. But it is what it is. So I talked about this a lot this morning. I think that, yes, we're going to have some pauses. We might have some pullbacks. We might have another melt up. Maybe this thing just, irrationally drifts higher. That's okay. The VIX, I mean, we've had one of the biggest crushes in VIX ever from a 60, which was like the, third or fourth highest VIX we've seen in the last 30 years, all the way back down to 17. So this VIX has dropped 71+% in the last month. Is that true? Just over a month of trading? Yeah, you're talking 28 bars. You got about 21 or 22 bars in a month. Yeah, so just over a month. It's crazy, right? 72% crush on VIX in just over a month. Thanks, Phantom. Let's see here. I saw you Simply Wall Street website. We look at stocks. What do you look at when you're expecting? Yeah, give me a stock you want to discuss. I'm usually looking at price to earnings, price to sales, discounted cash flow, valuation. Looking at the estimated targets. So where I don't buy things is, if we're trading at fair value, I'm usually not buying stuff. If we have, hey, this stock is 30, 40, 50% undervalued and the technicals look good, Fundamentals look good. Limited debt, decent amounts of cash, positive EPS moving forward. Guidance is optimistic. I mean, you get a snapshot of that pretty quickly on Simply Wall Street. Any updates on the dollar? Oil, I'm just going to go ahead and say oil is a toss up. I mean, oil's probably stuck between some big support resistance levels. So oil, I'll just drag this down here. There's support and resistance on oil. And, we've been making lower highs for a long time now. Okay. I think oil at best is going to come up to like 62, maybe 68. I should say about 65 to 68, and continue to use this kind of fake out 200 EMA, fake out 200 EMA, and then we would retreat and head back down. But question is the floor in on oil? Is there still resistance at the 200 moving average? And I think that's what oil is, right? Somewhere in here, like oil is range bound. I realistically, I should sell more premium on oil. I should get into the trenches and futures and sell strangles on futures, but it's undefined risk. And this is like one of the few instruments from nobody knows what oil wants to do, can do. It's so geopolitically motivated that out of just like one terrible headline, oil could be up or down, and it just disrupts all those like undefined risk trades. So I really don't trade oil futures that often. And I'm fine with that. I mean, there's other stuff I can trade. I like gold better. I like silver better. I like index futures a lot. So there's that. Dollar index. I think the dollar index is still just kind of slowly working its way back. So we're still in a pullback mode, right? So if you're watching and we get a trend line break, that's not exactly the perfect spot to enter. Like let's say we break the trend line in the dollar index, I wouldn't be necessarily entering there. But if I took a chunk or a sell trade and then reserved maybe another trade for this support resistance or another trade for here, I think I'm going to treat the dollar like this. If we're going to go back and retest the low, which I do think is a high probability, that would be my price target. I would be willing to say, okay, small trade, small trade, small trade. And I think the probability is you would see the dollar come back and retest the lows. So it's not picture perfect. It's not, call the top and trade confirmation, put a stop loss above the recent high. It is level in, level in, level in, and look to see if we revisit the lows. Euro dollar is the way that I'm doing that. That's the way I'm trading the dollar index essentially. So I am long euro dollar 111.80, 108.50, and 106.50. I'm looking to see if we can retest the highs at 115 on the euro dollar. Okay, so it's just the dollar index basically flipped upside down. There's my trade. So I could see the dollar, falling back, or the dollar getting stronger on retracement, which means euro dollar pulls back a little bit more. That's fine. I'll just wait, right? I'm taking some small tests in here. And if I draw a trend line and it starts to break the trend line, I might put some buy stop levels and stack these up. If I can get, let's say, trade 1, trade 2, maybe even trade 3 filled, and it goes back up to retest trade 1, I don't need to take profit up here. I can just get a break even on trade 1, take a winner, and get out of this trade for profit. So I'll work the area. I'll see if we hold like 106 back up to 111, something along those lines. But that's how I'm going to stick around with the dollar index. When it's going, it's going. Yeah, but then then it's just a constant game of guessing. When it's going, it's like, okay, well, when are you going to figure that out? I think oil is more of something like it's just a good talking point. I don't like to trade oil. I don't like to trade oil futures. I was long oil during COVID because it went to negative. Like futures market went to negative 33 cents. I was long everything oil when that happened. But that trade lasted for like 6 months and it was a great trade. Other than that, it's like constant supply and demand, bad news, good news. It doesn't really matter. Price just is choppy. It's interesting. There's a couple of macro analysts out there that I followed that were talking, maybe seeing oil down to like low 60s, maybe even the 50s, and then going back up over $100. And I'm like, that's a bold forecast, man. Like, I don't know how we would do that. Like, what would possibly be good about seeing oil prices go that high unless we're talking about massive inflation? All right. Swiss yen, was that the other one you asked for? Swiss yen? Why on earth are you trading the Swiss yen? That's like my least favorite currency pair. Swiss yen to me would be, if you're watching the structure, maybe something like this. It could break higher, but I'd like to see it break lower. This is a safe haven. Safe haven. I don't like this at all, really. Um, I mean, I do like it down here if you're going to buy this support, and I wouldn't mind it up here looking to sell resistance. In the middle, your guess is as good as mine. It's not volatile enough to scalp. I'd say if you want to scalp and try to grind out some pips on yen crosses, go to the pound yen because it moves 100 150 pips a day. But Swiss yen, I mean, they move the same, right? Wasn't it this week where we saw safe haven flows? Safe haven flows in currencies. I mean, look at this. This is yesterday or today? Yesterday. Swiss and yen were right next to each other. That's safe haven. Like they're gonna do they're gonna do the exact same thing. So I don't like that. If we have risk off flows and currencies, you're going to see them both strong, or risk on currencies, you're going to see both weak. So I just think that's not a good trade right now, in my opinion. There's other ways to exploit the yen or the Swiss for that matter. Okay, let's talk some Simply Wall Street here for Royal Trades. Usually trades along with XHB when you overlay it. It's like 6% undervalued DHI. All right, is that DR? That's not DR Horton, is it? It is DR Horton. DHI. Oh yeah, there you go. So it's a home builder. Did they? I mean, let's take a look at other home builders. Let's get a consensus here. So you have Pulte, which is PHM. Okay, which. So here's the bet. It's not just PHM. It's not just DHI. It's not just TOL. It's not just LEN. That's Pulte. That's Lennar. That's Toll Brothers. That's DR Horton. Look, the housing market. I don't know, man. I mean, I think what is going to happen here is supply continues to catch up. Supply is supposed to catch up. I mean, let's just talk housing for a second. Housing market, we have the, let's say the average. I'll just pull this from daily Mortgage News Daily. Mortgage News Daily. Let's see what the 30-year mortgage is right now. 30-year mortgage right now is 6.92%. Okay, we've got Freddie Mac around 6.8. I mean, that's terrible, right? So between 6.8 and 6.9, that's the average mortgage right now if you want to close on 30-year fixed mortgage. Okay, so my point is this. Right now we have housing prices still holding high prices. We have loans rates not improving. What was a historical average of about 2 times salary to own a home today is about 6 times salary to own a home. We also have home prices appreciated faster than the S&P 500 since 2009's low. If you overlay home price appreciation over the S&P, home prices have actually outperformed the S&P over the last 17 years. That is insane. Okay? So you're talking about home builders here. Look, I can see that they're undervalued, but if we go into a housing crunch, look, supply side is not going to improve margins for these homes, right? Home builders like Pulte, I mean, I built two homes with Pulte. They were a cost plus builder. I think they're pretty set on making like 20%. That's their margin, like 15 to 20% margin. That's how they build. And they're all kind of the same. I mean, they're competing tooth and nail out in areas like this when real estate is premium. But if they're just going to be forced to have supply side catch up, I think we're going to be stuck with a housing glut. I really do. I think we're going to have so much supply, and if rates don't come down until home prices come down, we're going to continue to see a very unaffordable housing market. So to me, I really don't want to buy a home builder right now. When I wanted to buy a home builder was when supply was so low that was the run that they all made. And that's when I traded it. I was trading PHM in the 40s. I was trading, LEN with LEN was a little bit more expensive at the time, but PHM, DH. I mean, I took some stabs at all these. I did a bunch of puts on PHM. I followed this one a little bit closer, just because that was the builder I was working with at the time. But I mean, look at this thing. This went from 40 to 160 almost, right? A 3x return on a freaking home builder. So, I mean, I look, I see this low, I see this high, I see it's kind of smack dab in the middle. it would make sense if this is an area to look to see if we can revisit highs. I just don't know how good margins are. I mean, if we're going to see just nothing but a housing market that is frozen, they build a bunch of homes that don't move, rates don't come down, house prices are still expensive. I mean, it depends on where they're building. I mean, if you're building in an area that's like, hey, look, we're going to build, and this house is going to be $500,000. Okay, well, are they building the home to still get their 20% margin, or are they charging more for that? I mean, what if that house just sits? Because they will cut into those margins. If they want to build a home and say it's a spec home for $500,000 and nobody's going to pay for it, then they'll discount it to $475. They'll discount it to $450, and they've got some room to work with, right? But they don't want to lose money on homes. So anyway, it's I would say this: I would be willing to take more trades on home builders because they have had a decent pullback. I would just like to see it maybe set a little bit more. I'm actually concerned about the next couple of years of what the housing market looks like. So I can't convince myself to jump into home buyers or home builders when this thing has gone up 300%. Take a look at DHI. DHI was up 195%, and it's come back down at I mean, that's respectable, right? I will say that from the buyers of DR Horton Homes, I have not heard great things. I've got a cousin that has a DR Horton home in um, North Augusta, and I know out here it's a pretty popular builder out here as well, but I haven't heard great things about it. Lennar, LEN, another one. I mean, they've given back a lot of these gains, but here's your big appreciation. I mean, this was up 200+%. We pulled back majority of the way. I mean, I think if you're willing to kind of sit on these, maybe, but for the options market, like they're not great. I mean, let's take a look at Ivy Rank right now. Let's go PHM, 14.4 Ivy Rank, and the thing's down 40, 50%. I mean, look at this discount. We are down from these highs, almost 50%, and yet we don't have any volatility that would justify selling premium. I mean, I'd like to say, like, sure, I'll just sell a put. Okay, but that put's going to pay nothing. If I sold a put on PHM, where's a level I'd say where I want to buy it? PHM, where's a good put? Somewhere down here, $89. I mean, this is a little bit more expensive. I mean, realistically, I'd say I'd own it at 70. Okay, so let's go out to the end of the year and look at a 70 put. Okay, so I could sell a put for $135. Okay, I mean, if that's some income, probability of profit's 90%. If I want to own the shares, I could say I'm going to own PHM at $70, which is a nice little discount. This would be down in here, about 55% off the highs. I could position for that. I probably won't get assigned. I'll probably just make it an income trade. So I look at it this way. I don't want to just buy the shares. I would craft an option trade with a backup plan being, okay, and I'm going to sell the put, collect the income on that put, and hope that it doesn't get assigned. Well, that's trade number one. If it does get assigned, do I have a backup plan, as in I have the cash to own the shares, and would I trade options around it to lower the cost of my ownership? So if I own the shares at $70 and I collected $1.35 on this premium, so I own the shares at $68.65. Okay, well, what happens if all of a sudden pull these down to $60? Well, the other thing I look at here when I do like 30-day calls is I go out 30 days and I want to sell an at the money covered call. Well, it pays me about $3.50 to $4. So over the course of maybe a month, I could lower my cost basis by another 5%. I mean, there are ways to take the shares at $68 and lower the cost basis down to $65, lower it down to $62, and you look at this level. And I think this is like just all the stuff that goes into the trade. If I was willing to say, yep, I would, as long as I could take some ownership and lower my cost basis down towards about $64, I think this has some good upside left in it, right? If this is like a longer term trend line out here, okay, or this yearly average is it end up getting hit, it's like I don't think I'd take the assignment, right? But it's just a stock. And if we, I mean, let's go back for a second. Let's have a history lesson here. How long did this stock trade for? Can we go back to the Great Financial Crisis? Because we probably can. So here's the Great Financial Crisis with a home builder. Well, from 01, and this stock goes back into the 80s, so I mean, there's plenty of history here. From 01, this stock was up 1,100%. And then what happens in 05, 06, 07. This thing is down 90+%. Do I want to own a stock that would be potentially fall, 93%? Probably not. And I know that was a long time ago, but if we have a housing crisis, that would concern me. Is that it's that economically sensitive, you know? So anyway, I'm talking a lot about these, but long story is short, I don't like the stocks. I think there's too much risk in the bigger picture. If we have a recession, if we have a housing market crisis or a crunch, if we have a credit event, I think that these get beat up even worse. Okay, so that's my thought. What IV would you need a minimum? I mean, Tasty has a pretty good formula. They're usually looking anywhere between like 30 and 70. The reason I took the trade on UNH this week is number one, it's like one of the worst performing stocks, but I think it's a little bit overkill. And the premium, I saw the IV rank up above 150, which is insane. Anytime I see it over 100, it's like something's going on with the stock. So I think it was a bit overkill. And the trades that I have on this one, I have a 270 by 260 ratio spread, and I have a 165 by 160 ratio spread. So what I'm looking for is if price can stay greater than 270, I'll make $500 or $600 on that trade. If the 165, 160 can stay above 160, then I'll make about 400 and some bucks on the trade. So shouldn't be terribly difficult if this thing just stops going down. But we don't know. Maybe this is doomed to fail, and maybe United Health Group will forever be busted up. It's like all the bad news happen at once. You have a CEO that gets murdered. You have a CEO that steps in and steps down. You have DOJ probing on basically insurance fraud. And okay, I mean, it all happened all at once, like within the last couple of months. So that's a lot of bad news to navigate in such a short amount of time. Has this stock ever had that type of collapse before? Not really. So again, it's a trade. I can still lose on the trade, but I think the implied volatility was so high that the reality is we're probably going to see some stability in this near the bottom. So that's what I'm going to watch for and see if we have a bit of a gap fill. I mean, these trades, by the way, both of these trades, if we go up just a little bit, both these trades start to show more profit, and that's probably good. So I'm trying to play the game where the expected move, because of the high implied volatility, the expected move is greater than the actual move. If I'm a seller of premium, that is what I want all the time, right? I want to sell the expected move, and the actual move is far less than that, which means I never take assignment and I collect full income on the trade. That's how it works. And most of the time, option prices do reflect that, especially when we have times where there's elevated volatility. That's why I'm getting a little bit, concerned right now. It's like we're getting volatility that's going down so low that I wonder, like, what is the next volatility event? Maybe it's the reality that in July we're supposed to come off this 90-day pause. What's the entire global economy look like with this tariff window, right? U.S. and China pushed another 90-day pause. What deadline is that? I don't know. Maybe September. The Fed has pushed back rate cuts until probably July or August now, or September. If you go to the watch tool here. So June pause, July pause, September maybe about a 51% chance of cutting. So they keep kicking that cut down the road, and maybe investors are going to see 1 to 2 cuts this year, maybe, right? And that's fine. I mean, the Fed has been pretty consistent every single FOMC. Jerome Powell's comments, and anytime he's in the press, he's kind of saying the same thing. What are they watching closely? They're watching labor. They're watching jobless claims. They're watching inflation. They're watching headline CPI. They're watching core PCE. They're watching all those primary data points. They're watching yields. I mean, yields haven't budged, right? You go to US 10-year yield, it's not really going down. Here, and I'm still going to keep this on the chart. I'm going to keep this Liberation Day low. It's like this is what made the market flinch. We had basically a blow up basis trade in 4 days of trading that it ruined a lot of good liquidity in the markets. Hedge funds started to dump bond positions. I'm sure foreigners started to dump bond positions. And I mean, we're looking at the bond market just kind of in this permanent lull, So and here's the next test for the bond market. If we have a sell-off in the stock market at all, okay, at all, let's say the stock market goes down 3 to 5%. Is there any pop in the bond market? Any at all? Because that would at least show that there is still some safe haven price action in the bond market. But if the stock market drops 3 to 5% and the bond market goes with it, for right now, bonds are dead. And I want like little to none in my portfolio. I would rather take all my TLT and replace it with GLD. And I have a much bigger position in GLD than I do in TLT. So what I'm doing on TLT actively is I'm lowering the cost basis. Okay. All right. Does that make sense then on the question there, MP, for the minimum to sell premium? So, I mean, if you're looking at Tasty, if you use their IV rank, you can sort. So if you're looking at like liquid, let's go high option volume, liquid ETFs, liquid symbols, something like that. You can sort by IVR. So there's UNH at 101. I mean, and some of these are stocks I don't really want to trade. I mean, I don't want to trade Nikola. I don't want to trade what's X, United States Steel. I don't care about that stock. I mean, some of these, it's like I don't trade all of these, but some have some. I mean, Oracle at 53, like that's not bad. Let's go Snowflake at 52. That's not bad. Let me write these down. So Oracle, so ORSCL. We've got Snowflake. We got Lululemon. Okay, GLD is not awful. Okay, what else? First Solar, NDX. Is that the NASDAQ? Yes, NASDAQ. Palo Alto, that's not bad. So PANW. Dell's not terrible. UNG is natural gas. This is AVGO, that's Broadcom. Not bad. Marvell, like that's in semiconductor space. CrowdStrike. So yeah, I mean, that's an easy way to sort it. If you want to sell premium, it's kind of that like 30 to 70 IV rank. Anything above that is like pretty crazy. That's high volatility. Look, I'm taking a stab at UNH, but I know it's a risky trade. Okay, Adobe, that's up there too. ADBE. I'm not sure what happened to Adobe. I think that they do have a pretty good looking trade. Target, I've got some ratio spreads on Target when premium was super high. All right, I'll take a look at some of those real quick. So let's go Oracle. I mean, Oracle still has a relatively high IV. Earnings is out into June. See what they say here. Should have a pretty good Snowflake analysis. Yeah, I mean, it checks a lot of boxes. High level of debt. Well, welcome to the club. That's pretty much every company. Price to earnings, a little bit high in the PE ratio. I wish this would show historically overvalued. I mean, here's fair market, but price to sales. Let's find out. I mean, that's respectable. So we have some growth to the upside. Against its peers, I mean, Palo Alto price to earnings, Microsoft price to earnings, Oracle is about the same. Microsoft has been way higher on performance than Oracle. So, I mean, it's not a bad trade. What would I do here? Well, if the IV is still 50, is there a way I could construct a ratio spread at like the 120 level? Maybe, right? I mean, I'd hope so. Let's see if we can do something like that. So I'll look at Oracle. And let's go out. So we have earnings on the 10th of June. If I went out, let's go 90 days. I'm looking at prices here, 120. Okay, so ratio spread, 125 by 120. I mean, that's not really worth trading. I'm not going to tie up that much capital for potential assignment and repair at 70 cents. Not that excited about that stock. If I just put in a naked put, okay, fine, I get $100 for it in 90 days. I'd like a little bit more premium for that, if possible. So again, it's like I'd have to love the stock to take that trade. Do I love the stock? Not really. If we had a pullback, maybe. Let's go to some other ones. Snowflake. I mean, this one concerns me. I think there's some. I looked at PayPal this morning. I did take a trade on PayPal, but that's a pretty good range on Snowflake. I missed it. I missed the trade around $100 and some dollars. The trade here was at 2022 lows. We came in there September of 2024. We just came off those lows again in April 2025, just under that like 120 handle. But that would have been a nice spot to look at a ratio spread, maybe consider some 105 assignment, 100 assignment. That'd be lower than the 2022 lows, but I missed the trade. And all that would have been is sell premium, price goes up, collect the premium, easy trade. Now it's like, well, do I justify this going higher and then take on the risk of this thing pulling back? I mean, that's the trade. So the question is, can I put in a trade where if I was willing to own Snowflake, and let's check it out here. If I'm willing to own Snowflake, I would say this is my big red flag here. Currently unprofitable and not forecast to become profitable for the next 3 years. I don't love that at all. That's pretty weak on the Snowflake analysis. That's not checking a lot of boxes, and unprofitable. I don't love that at all. So I think that's a higher risk tech stock that I would say I'm not that interested in trading. I'll cross it off the list. Lululemon, premium retailer. Who do you want to pay $150 for a pair of pants? I mean, it's athleisure, overpriced athleisure, but people love it. They've got a big following. And this is an expensive stock. Do I want to own shares at $238? Not really. I don't want to tie up capital in Lululemon. What's it look like from a fundamental side? Okay, so financially healthy, past performance has been good. Earnings forecast to grow, but let's see where the price is detecting. So 21 times price to earnings, current price, fair value. Well, there you go. Not interested. Just a little bit of sifting, a little bit of digging. It's like, yeah, I'm not going to take a trade when there's no upside to it, not from what I see in a discounted cash flow model. So if we come back down to these lows, yeah, let's have a conversation about Lululemon at 238. I'll entertain that, and I could be wrong. Maybe it goes to 420. Okay, but I'm not going to take that stab. So if it comes down, or the retail, the customer cuts back on retail spending, then okay, fine. Or there's more competitors out there. Like, I think it just ultimately drives Lulu prices lower. So anyway, Costco clothing only for me. Hey man, don't knock it. There's plenty of options out there. I've thrown in some Costco wardrobe in my day. I don't feel bad about buying anything when it's like $10 to $15. Half the crap I throw away. Anyway, but it's you get some name brand stuff from Costco. It's not bad. All right. Anyway, crossing that one off the list. GLD. Well, we all know that is. GLD is pulling back. Great. I want to see a pullback. I want to continue to see a pullback. This to me is more attractive in the deeper retracement zone. So what do I do on GLD? Right now, nothing. I'm going to wait and see if this will continue to make, lower highs and lower lows, and maybe it's a nice, like, organized pullback, or it continues to fall a little bit faster, comes into some levels that I'm more interested in, and then I start looking at bull call spreads. I start looking at bull put spreads. I start looking at something long. I start doing something synthetic. I start adding more shares. But I want to see if I get a discount on that first. I don't wear Lululemon. No, I don't. In fact, I have 2 pair of pants that I've never worn from Lululemon. It was almost out of principle. It's like I can't justify having a $150 pair of like polyester khakis. So they sit with all the tags on it. I haven't worn them. I know they're nice pants. I've bought in competitors where it's like, oh yeah, it's kind of like Lululemon. They're not. I mean, it's to support Lululemon. It's fairly high quality. It's like they're supposed to not like break down and fall apart. But I've also been in the store when I've seen people try to return their pants or any of their athleisure, and the staff gives them a pretty hard time in making returns. Which I'm like, look, man, if you want to keep customers happy, take all the returns and give them new stuff. It's like people are just chilling at their home wearing Lululemon. So anyway, I don't wear Lululemon. Correct. All right, GLD. So nothing to do on this one unless we get a deeper pullback. What else? Palo Alto. Again, I missed the trade. We came back down to the 24 low. We came back down near the 24 low. Very volatile. It's like I think there's limited upside in this one. We could go higher, and sure, you never know how high a stock's going to go. But even if it's support, resistance, I think it's more limited to the upside. I'd rather hold out for maybe a chance to buy this thing at a lower price or sell some options if it is coming back down to these lows. So, I mean, I'm just out of a price and analysis standpoint, I'm not going to take that trade. What else? Dell Computers, okay. Lows at 66. Are they in the AI space? Maybe. Yes. Let's see what they look like from the fundamental side. Decent. Debt's high. That's not great. Trading well below estimated values. Forecast to grow by 10%. That's all good. Price to earnings, not terribly expensive. Okay. 166 upside. We're trading at 110 or so. I'm not interested in buying at 114, but a dip or a pullback. I mean, $100 maybe. Obviously, the lows we had in April were fantastic. So, is there a way I could craft a trade where I can trade this thing at $70? I'd have to go out probably farther in time. Earnings are end of May, so this is a couple weeks away. If I went out, 90 days, can I get something at $60? 1 cent. So the answer to that is no. Can I go out to the end of the year and say I'm going to take a bit of a long-term play on Dell? Okay, like this isn't awful. We came down to $67 if I want to sell some puts. Okay, I mean, this isn't bad. If I'm willing to own some shares, I could do a 70 by 67.50. That's not a bad trade. So I could do a ratio spread about a 90% chance of profit. There's about a 7% chance of assignment according to options right now. IB rank is fairly high. Again, I think this is fair to say that maybe the expected move is greater than the actual over the coming 245 days. If we end up going higher on Dell, then that ratio spread decreases. So my credit that I take in, I just see it, premium time decay, right? So time works in my favor. And if I pull it in for $1.42 and 45 to 60 days later, it's trading down for 42 cents, then I get a majority of that profit and I'll take the money and run. So that's not a bad trade. But that's how I'd look at it. I mean, if this goes up, I'm going to take a trade that as long as we don't come back to the April lows, I think it's a good trade. Now, I could just sell a put. I mean, there's a couple ways I could craft this. I could say, okay, what's the low? Well, the low was 67. Okay. So if I were to just sell the 67.50, I make $169 of income. But that doesn't really help me as far as my cost basis. I would own 67.50 minus the $1.69. I'd own shares at 65.81. If I do it as a ratio spread, okay, I sacrifice about 27 cents of credit, but I can lower my cost basis if I take assignment here. So 67.50 minus $2.50 in the ratio spread minus $1.42 on the credit. Now I own the shares for $63.58 as opposed to $65, right? So I can lower the cost basis a little bit. The delta on a 65 is 6, which means I have about a 94% chance of this trade still being something I can work out by the time January rolls around. Yeah. What's up, dude? Hey, what are you doing? What are you doing? So anyway, I like the trade. If I wanted to move this up, so expected move is about $32. We're trading at 114. Again, expected move at 32. I'm putting price what, $40 to $50 lower with an expected move of $32 on. This is what I'm talking about. The expected move is greater than what's most likely calculated as the actual. So I could obviously go, okay, well, I'll just do a $30 move and bring this down to $80. Okay, well, that's a good ratio spread. I get $243 of income on this one, but now my chances of profit are 84% versus 90%, and my risk of assignment increases from about 4% to now like 12. I'd rather just say, you know what, I'm happy making about 100 and some bucks on the trade, so I'll do this one here. The only caveat is I have to own the shares. If I were to take assignment at Dell, I've got to own the shares, right? That's the only drawback is I have to own the shares, but chances of assignment are pretty slim. Because I own the shares around $63. By the option chain right now, this is trading for maybe a 4 to 5% chance of getting assigned and having that break even at 63 and change. Okay, now before I take this trade, 30 days out, what is my at the money covered call? I mean, this isn't bad. I can get $7 to $10 for an at the money call. It's like, okay, so I can lower the cost basis pretty aggressively. All right, look, we just found a trade. So I'm going to take this trade. I'm going to buy the 70 put for one contract, sell the 67.50 for two contracts, collect hopefully $1.40-ish, and then let the trade marinate. It's an income trade. It's nothing crazy. Do I want to take a bunch of shares? No, but I'm willing to take 100 shares and flip it. I could flip it for maybe $3, $4, $5 with a covered call if I had to. Otherwise, I just generate the income. I know I've got to go out a little bit longer in time, but it's not going to tie up a bunch of capital. So let's go for it. I'm going to take this trade. So pending at 144. Let's try 140. That's just below the mid price. Filled at 140. Okay. Next account here. 140. 140. Make sure I put that in 3 times. Yes. And 2 more accounts. This one. This one. This one. And this one. Okay, trade's in. So new trade on Dell. Dell, it's a 1/16 expiration. Buy the 70 put, sell the 67.50 put with 2 contracts, collected $1.40 credit. Willing to own. If assigned, that break-even price would be 63.58. Okay, again, that math is this. I get assigned if price is below 67.50, take away the 250 on the debit spread side, and then take away the credit at $1.40. So 63.60 would be my break even. Okay, so trade is in. Little income activity right there. Dell 1/16 expiration. Buy the 70 put. Sell the 67.50 put. $1.40 credit. Ratio spread, willing to own if Dell is less than 67.50 by expiration. We have on this trade about a 90% chance of profit, 90% probability of profit. We also have about a 5% chance of assignment. Okay, if I build this out, let me see if I can put this in for, this would be, what did I just do? Dell. Let's go out to January, and I'm going to sell the 67.50 and buy, oops, not buy Dell. Get out of here. I'm going to buy a put. There we go. So the buy put's at 70. There. So now I have 2 strikes that are selling, 1 strike that is buying. Zoom out. There's my ratio spread right there. Implied volatility is 49.2. So right about there. So that's the trade. All right. Project. Put in another one there for Dell. Okay. What other ones? We have Dell. We got Adobe. Let's take a look at Adobe. Got a few more minutes for the close. Adobe. I kind of like this one. I had this level marked around the 2022 lows. It's an expensive stock, so I don't love this one. It is on the pricier side versus Dell, but fundamentally, let's see what old Adobe has up its sleeve. I mean, this one checks a lot of good boxes here. Um, I mean, maybe an out-of-the-money bull put spread would be pretty decent. So undervalued. I mean, looking at a $600 fair market value, a bull market would be pretty darn good if you ask me. One thing I don't love about Adobe is we haven't taken out this recent high, so we're still making lower highs on Adobe. But I mean, I think if there's a channel here, we probably have room to go back up. Do we come back down and revisit the lows? I'm probably not going to take a trade on this, but if I were to take a trade on this one, it would be, let's come back and see if we have any pullback. Rejection off the 200 moving average, maybe in this higher low area, maybe looking at something in the 300s. So, I mean, Adobe in the AI space is dancing around. I mean, this is, I don't know, it's okay. I think that in the open AI space, Adobe's they're playing around in the sandbox. Fundamentally, it looks okay. It's not terribly expensive. Any pressing news? So if we go Adobe, any crazy news here? So Adobe, investor attention, okay. Final trades, stock is a buy. This is all today, Barron's. I mean, if there's any insider trading on Adobe, that'd be nice to look at. If you got like Quiver Quant or even Unusual Whales has some of that stuff in there. Wall Street analysts look bullish on Adobe. Okay, that's all like yesterday's news. Okay, so anyway, it's on the radar. It's expensive though. It's like, do I really want to own shares of Adobe? Well, if I did, then I'm going to take it at like the October bottom, and that'd be like a 280. Now the nice thing here is Adobe is a little bit high in premium. Ivy rank is 72.4. Like that's pretty high. Again, the expectation is that the implied volatility is greater than the actual move. So if I sold premium on it, what would 90 days look like on Adobe? Could it get a trade out 90 days with like a 280? I mean, 280 on a $280 stock, it pays me 28 cents. So obviously that's not the trade. If I went out farther, I'm willing to take on some more risk into January, go out to 280. This is probably the trade I'd consider is like a 290 by 280 ratio spread. I get $473. I mean, if I'm willing to say the same thing, I don't mind taking the shares. I'm going to assign it. It's a 93% chance of profit. I do the same math. The Ivy rank is high enough. We have earnings on this stock when? In June. So if they have decent earnings, I mean, it's Friday, so I'm not taking this trade right now, but I'm curious if I visit this trade on Monday. I don't mind this trade, but this is going to be a trade that I'd have to potentially allocate, 20 some $1,000 to if I want to own the shares. Now, break even on the trade, I get a $1,000 bump, so 280 minus 10 minus 473. I'd own shares at 265. Okay, so from these recent highs, what's a 265? Well, from these recent highs, 265 puts me down below the lows. That's a 58% discount on the stock. Okay. From the all-time highs, it's a little bit better, but it's below the bear market lows in 2022. Okay. So if we have a, uptick, I pull in $4.70. My goal on this 470 credit is to have this 470 credit show $1.70 debit or lower, and I'll protect the profit. $1 or lower, I will definitely protect the profit. 70 cents or lower, I'm just going to close the trade. So is the expected move greater than the actual? If there's an uptrend coming in Adobe, then this is an easy trade. I just have to allocate for it. There's a plan B, which would be I take the assignment. There's a plan C, which is I wheel myself out of the trade with covered calls and I repair it. But I have the capital to do that. Okay. Both, Maddie. Yeah, I mean, you'll see IV on like most platforms. You see IVX on most platforms, but I pay attention to IV rank because that's kind of Tacey's patented deal. Like between the 30s and 70s, they do a lot of premium selling, and they are, kind of they're not necessarily strategy agnostic, but they're asset agnostic. I mean, what did we just do today? I sorted by IV rank and I found 1, 2, 3, 4, 5, 6, 7, 8 symbols, and I'm like, yeah, I'll take a look at them. I took a trade on Dell, so that's one trade that's filled. I don't mind Adobe. I just have to trade it with the accounts that I have more money in. Like these accounts that I just highlighted, these are all margin accounts that have, 6 figures. I could allocate 10, 15 grand to it if I needed to, you know. So I don't mind doing that allocation. It's not like I'm risking that much money, but I could allocate to it and then flip it for maybe, 10% return on capital. Grab $1,000 net profit. I allocated 10 grand to the holding position. Okay. So I make 10% return on that position. Cool. Does that make me a bunch of money? It's going to be a fraction of 1%. I grab a 0.1% gain. I grab a 0.1% gain. I do that thousands of times, and all of a sudden I'm, still making 25, 30% a year. It's okay. It's just a trade. So anyway, I like the Ivy rank and Tasty because it kind of gives me, when premium is likely overstated, then I try to take advantage of that. So I'll take a look at Adobe for next week. I don't mind that trade actually. It's expensive, so I'm not going to do it on all my accounts. But 6-figure accounts, probably yes. All right. So we just finished shy of the 595 level. We're going into the weekend. Let's see what happens next week. Tail of the tape today. Markets are just melting up higher. Finished on a Thursday, Friday with highs once again. Here's the day. Thursday was higher. Friday was higher. We're creeping up into like only 4% away from all-time highs. 3.1% away from all-time highs. So let's take a fun little guess. Question to all of you before we go. Are we going to hit all-time highs, or are we going to fill this gap? That's the quiz for today. Okay. Are we going to hit all-time highs, or are we going to fill the US-China news gap? That's the question. So you can type in your response. I can see comments afterwards. We're only 3% away. We're only 3 or 4% away. So it's a coin flip. Obviously, the momentum's been up. We just finished an OPEX cycle for May. But I'm curious, do we creep up here 3%? Do we pull back 3 to 4%? I mean, where's the resistance at, everybody? There isn't any. You see resistance here? Nope. Here? Nope. Here? I mean, maybe that candle. But it's like, if this market just does nothing else but melt up, I'm like, yeah, I guess we'll hit all-time highs. So we'll see. What do we have? So all-time gap at the highs. Want to see the gap? I mean, I do too. I want to see gaps. I want to see the gaps get filled. I want to see a gap get filled. Please, give me a pullback. I've been saying that all week. I just want to see a freaking pullback. And again, I'm not getting it. I'm not chasing this market. So I'm participating in ways that I'm just trying to generate income. Highs then the gap. That's possible. That's very possible too. Mad greed coming. I mean, it's kind of already there. It's just more of the same. If it's more greed coming in, then sure, we're talking what seems to be just a freaking irrational market, man. Wild stuff. Resistance is in my portfolio. Going to buy the gap. That's cool. All right. So before I go, just a couple things here. I mentioned this week. The whole job of a trader is to trade through anything. This is what we've been doing. I do have some exciting stuff coming at the end of the month. We're getting a big rollout ready. It's going to be my pinch point, excuse me, pinch point pro. It's going to be a scanner, dashboard combo, and an alert service. Basically, it's a trade idea generator where I can take almost 700 instruments. My watch list is about 700 different tickers and ETFs, and try to find some trades. And realistically, on a week-to-week basis, I'm usually getting 5 or 10 that are actionable, and I'm trying to find some really good-looking trades that price out the way I want. This gives traders. It's really simple. I'm doing this with a get ready, get set, and a go. And what I'm focused on trading are the last two. If I've got a trade that's primed and getting set, that means it's like the trade is about ready to move. And then a go is we're already starting to see confirmation, and it's kind of like a no-brainer. That's the hardest one to find, is when we have scans in the go section. So I'm trying to make it really simple. And then on top of that, there's a directional play, which is basically a break up or a break down. which means ideally we're looking for a trade that is primed and ready to go up or primed and ready to go down. In this environment, don't fight the bigger trend, obviously. So if the market is overall bullish, then the probability is probably going to be based in like a 55-cent baked in bias of you get a trade ready to go, breakup is lining up, you're probably going to increase your probability of winning. That means you can also trade one side of the trade, risk less on the trade. So that's all coming here. I think May 28th, May 29th, you'll start seeing a little bit more webinars pop up in my Telegram channel, Discord. So if I've got some interested traders or followers out there, that's what I'm pretty excited about. This has been in the works for about 4 months now. So the team's done a pretty good job on it, where it's just going to be like a house website with real-time data, and members have access to that. So let me know if you're interested. All right. I wonder what Buffett thinks with all that cash on the side. I mean, I don't think he cares, honestly. I think I know Buffett's 94 years old, but the guy's not in a hurry. When he ultimately steps down, if they stick to the methodologies of Warren Buffett, they're probably just going to sit with cash on the sidelines, generating yields on treasuries with all that cash. They're still going to get 4+% on that cash, right? And they're probably going to sell covered calls on their income trades, and they're probably going to collect dividends in their dividend portfolio. And they're going to sit and waiting for basically the market to offer up some real value, you know? So I don't think there's any reason for them to rush in. If you look at the Buffett indicator based on total stock market value over US GDP, it's way overvalued. Doesn't stop the market from going up, So we'll see. Yeah, I agree with that. The most hated all-time highs. To me, I've said it. I mean, I think it'd be a stupid all-time high, because basically, look, if Trump says "I told you so," and that's your way of making you feel bad about not participating when he said buy back on April 9th, or buy again like right before the U.S.-China agreement, it's like, the hell kind of market is this? Like, that's ridiculous. So it just feels like, I mean, and I keep going back. It's like, look, I did well. I courageously trade through all the scare, the fear, and it's fine. But this last little stretch of hitting the pause button for about 6 or 7 days in a row, and now going up another 4.5%. This is what's starting to piss me off. This is not this reflexive rally coming back to resistance. Not that. It's this extra 4.5%. Because why? Why? Right? Nothing's really changed, but what are you going to do? So I'm going to complain about it, but I'm still going to trade it. So I'm just trying to find ways to not buy highs. I don't want to feel like we're getting ripped off on these stocks that have just, bounced so hard. I'm not going to chase this thing at the highs. It's like, give me a pullback and I'll trade it. Give me some pullbacks and I'll sell some options. So that's kind of what I'm looking at right now, is if this is the bottom, well, there's lots of ways. Like, this market can do all sorts of crazy stuff in here, but as long as we don't come back and revisit April, I'm going to be fine. And if we go to all-time highs in a bubble, that's fine too. I'll participate as much as I can, as much as I'm comfortable. Right? All right. 100% that 4.5% is triggering. Yeah, I think so too. And I'm not the only one. So here's what I do every weekend. I usually spend about 3 to 4 hours out at the gym. I listen to podcasts at 1.5 to 2 times speed. I soak in all this extra content. Just keep kind of building the macro in my head, and come in ready to grind next week. I try to just think big picture and see what's going on, and it's like get kind of both sides of the analysis, and do my thing every single day. So anyway, I don't know, but that's why I'm asking. All-time highs or the gap? And obviously, we could hit all-time highs first and then fill the gap. That's going to make people mad too. It's like, wouldn't it be nicer for the investor out there to have a chance to participate in a pullback and then see the market go to highs? But I don't think that's going to happen. I mean, honestly, I think the more realistic play is this: the market's going to come back to all-time highs. This isn't guaranteed, obviously, but if the market comes back to all-time highs, I'm not going to like this, okay? And I would think that from there, yes, we have a realistic pullback that hopefully fills somewhere in here, potentially down into here. And that would be, to me, a larger bullish pattern that we can participate in with the market trying to get to all-time highs. Okay? We'll see. Yep. All right, I split it over 2 days. There's Saturday and Sunday. I go Saturday, Sunday. I usually sneak in one workout through the week, and then I go Saturday, Sunday. So, but it's funny. It's like I literally listen to financial podcasts at the gym, so it's super motivating. No, it's fine. I mean, you just do your thing. All right, I'll let you go. Um, yeah, I mean, and in the background, it's like, yeah, the bond market. As long as the bond market doesn't break, as long as the Fed doesn't break anything, Trump and company are probably going to continue to celebrate all-time highs. They want liquidity, they want stability, they don't want to disrupt the bond market. They want stability, right? But the equity market, as greed grows, it's like, well, it gets into very bubbly territory all over again. And look, I don't know how high this can go off of these levels, but let's just do one more thing here before we go. Look at the yearly candles. Let me go to XSP so I can have a cleaner chart. Okay, look at the yearly candle. Okay, so we've had some doozies in this market, okay? But even with some of the most ridiculous moves, this is 2020. Here's 2020. This candle from low to high was 70%. So don't think for a second that there's a top in this market. COVID was 70%. Now, yes, I understand that COVID had $6 trillion hit the market because that was the global reaction to it, right? So I don't think it's that necessarily. I don't think we're throwing $6 trillion at the market or $10 trillion at the market. But if Trump's going to pass a tax bill for what is it? I don't even know what the combo is. We're basically trying to raise the deficit by like $4 trillion, pass a tax cut for $1.5 trillion. It's just the same. It's the same crap that we're going to operate a deficit. Fiscal policy is going to be alive and well, just like it was the last 4 years. And it just sounds different because it's Donald Trump saying it. But the government's still spending. The Fed is the difference here. The Fed is not really doing anything, right? But I mean, COVID was a 70+% year, so that puts it into context. This was a 29% year. That was 2022 before we had that was 2021 before we fell. 2022's decline from high to low was around 28% in the S&P. We responded with that Q4 rally, and we had a rip in 2023 for 24%. 2024 was a pretty good year, right? Roughly here, about a 25%. We got up to as high as 30%, pulled back a little bit towards the end of the year with the Fed in December. But here we are already, the candle low to high. So far, the market's already seen about a 28% move on the S&P. That's a lot of volatility coming off of a 2-year run of 20+%. Historically, I don't know if we've ever had 3 years in a row of 20+%. We can look. I mean, go back in time. Have we had 20+%? I don't think so. Right? Body to body. Let's find out. So body to body here, this is up around 23%. Okay, followed by 15, followed by nothing. Flat year in 2011. So it didn't have a third year. That was positive. That was significant. There's 14%. Well, that's not 20. Okay, this is rip here in 2013. 2013 was almost 30%, followed by a year here. That was 10%. What was the third year? Flat. How about here? 1 year, 2 year, flat. 1 year, 2 year, 3 year. This is probably the biggest run we've seen. That was 2019, okay, into the fade in 2020, but up and up. That stretched out 93% in 3 years. 2019, 2020, 2021, up 95%. That's insane. The power to double your money in 3 years by just being a holder, you know? So here we are at another run of 20+%, 20+%. We've already stretched 60%. I mean, I'm going to put this in context. This was a 90+% rally right here. We're already up 60% in these last 3 years. Okay. Now, again, context is 90% in 3 years. Could we do it again? Could we have this go up another 30%? Anything is possible. You know, going back historically, we've had 1 good year, 2 years pause, right? And I think that's what everyone expected this year is like little to no gains. Valuations are high. It's going to be difficult. Nobody knows. So I think what would honestly feel and I don't want to hate on the markets. If we're going to all-time highs, we're going to all-time highs. Okay, so be it. But if we have a market that is going to fail at the high, fail at the low, and the rest of the year is just a bunch of noise in here, I will do absolutely fine in that environment. Okay. It's the irrational, bubbly market that I'm not going to really have a fun time participating in because I'm not going to chase all time highs. It's just not my style. Right. So we will see. But I do think it's possible that we could be in the stages of a melt up for a global bubble. I do think that would end terribly at some point. It's just when is it a year, 2, 3, 5 years from now? Who the heck knows? But if we at least have a responsive market where we don't really get too much higher, we don't revisit the April lows, we finish finish the year here maybe like 5 to 10% off the highs for the year. It's like okay, with a lot of volatility, we still finished a 5 or 10% year. I don't know. I can stomach that, I guess, as opposed to a 90%. Like, I think this is ridiculous. But if we do it again and we're talking another 90% from 2024 or 2023, 4, and 5, it's very possible. Right? What's a monthly candle here? Is it a fifth wave? I thought we started wave structure here. 1, 2, 3, 4. Yeah, I can see it. In fact, let's just do it. Let's take a look. If this is 5 waves, here's a forecast. So you take your COVID low. Okay, oops, wrong button. You take your COVID low. This is the last time I thought we had a bit of a shakeout in the wave structure. So this low to this high, and we had about a 382 to 50 pullback. 643. This is on an XSP chart, but around 643 would be that potential fifth wave move. So somewhere in here. Okay, so if we did 6430, that could be the technical window for the SPX. Okay, what is that percentage now? We're at 595. So let's say we get to 643. That puts us up another 8%. Well, that gets us all-time highs. And then some. So, but I do think that the bond market and the yields and choking off growth, that is going to be an issue. It just might not be something we have to really worry about right away. I think that's what the flinch was in April. It was a hard flinch by the Trump administration. It was a heavy pivot from the Trump administration. But, again, just looking at some bigger picture technicals, this would make some sense. Anything above 643, to me, this is bubbly territory. So, all right, everybody, I'll let you go. Have a great weekend, and let's come back and do this again mañana. Okay, see you, bye.